All right, I'll cover a little bit of the agenda for the day because I got like a handful of topics. We're not gonna like spend a whole lot of time on one individual thing, but I have a bunch of stuff I wanted to talk about. First being the market. Well, I wanted to touch on some of the stuff on our website too first, and then the market, and then some like recent calls we've been getting, temporary buy downs, arms, shorter terms, so shorter term loans, I should say. So like the 15-year and 20-year and how those compare to the 30-year. And then new construction, and a couple parts of our new construction program. All a handful of calls that myself, Sean, and Don have gotten over the last couple of weeks. Thought it would be good topics to cover. So I'm going to hop in first here with my web page. So this is my page, ccmbullock.com. Sean's is ccmgreatercleveland.com. And then to be honest, I don't remember what DJ's is, but I'm sure if you Google Don Jarecki, CCM, it'll be the first thing that pops up. So our webpage, most of the time, someone hops on here, they don't click any of the links or look at any of the stuff. They just click on either this button right here for apply now or this button right here for apply now. They effectively take, our clients to the same place, they create a password and fill out a questionnaire, and there you go. Now they're applying for a pre-approval. But there are a lot of like really useful things on here, both for yourselves and our clients. So some tools and articles about being a home buyer, first-time home buyers, what purchase loans look like, what down payment assistance programs are available, questions about refinance, my loan officer, that's just like a little bio about me. So a few different loan programs that we offer. Obviously, home purchase is most popular, but we also have home equity loans and down payment assistance and such. Where I usually tell people to check out, aside from the apply now button, is the resources tab. So there are calculators on here for calculating the benefit of buying over renting. Super beneficial. If someone goes in there, plugs in their rent, plugs in what their anticipated purchase price would be on a home, it'll lay out what the cost benefit is of buying versus renting over the next 20, 30 years that they plan on living in that home. Um, there's articles on here. That's a great resource for myself, frankly. My marketing department writes up all this stuff. They're releasing articles all the time. If I'm ever like, man, I really got to post something on Facebook or I got to make some kind of post today. It's been a while since I've posted anything. I'll go straight to this articles page. This is a resource that, we encourage all of you to go ahead and take advantage of as well. Feel free to take that link, copy and paste it in your Facebook post and say, hey, here's this cool new thing I just read about from Sean Hadley at CrossCountry Mortgage. Um, there's a handful of different videos, mortgage terminology, but usually it's these first two calculators and helpful articles. The next page I'm going to go to is about our corporate sponsorship. So this is a bit of just a CCM plug. So we are the Brown sponsor. Specifically, we have a named sponsor inside of the stadium, which is cool. It's awesome to be there and see the logo and everything everywhere. But the practice facility in Berea is also named I believe it's the CrossCountry Mortgage Browns practice facility, something like that. We're also a huge contributor to Cleveland Metro Parks. If anyone's been to the zoo for the Asian Lantern Festival, um, we are a main name sponsor for the Asian Lantern Festival this year, as well as we've pushed a ton of money into the metro parks. So it was funny. I was at the corporate office the other day, and in the big atrium area, they had a little Asian lantern setup for us. Like they had, set everything up at the zoo and then came over to the corporate office to set up a little bit in the corporate office. So that's pretty cool. So if you're around town, keep an eye out. You'll see the cross country logo. So um, let's see here. I think I'll jump into market update. So anybody that watches the stock market, you probably noticed we've been we've been green for the last couple of days. What's that all about, right? Well, it comes down to this chart right here. And this is the Consumer Price Index, CPI. It's one of the main inflation indicators that kind of help feed the Fed. It's not the Fed's number one inflation indicator, but it certainly helps drive what decisions the Fed is going to make. Now, if we jump back last month, there was a big jump up in inflation. A lot of people thought that was because of tariffs. And the expectation was, okay, well, if the tariffs keep coming, we'll expect this number to go even higher. That means inflation is increasing again, and therefore the Fed will be dovish. They'll want to stay put and not want to make any changes. Well, when this reading came out, it came out flat for all items. Inflation's up a little bit for items aside from food and energy, but all items flat. Feels like nothing, right? Okay, nothing changed with inflation. No, it was great news for the markets because now they believe that's enough for the Fed to start cutting confidently. So that's what caused the change in the market, the little news blip here in the market. If we hop over here, this is basically just an estimation on what we expect the Fed is going to do with interest rates. Not we, but a group of economists expect the Fed is going to do with interest rates at the upcoming meeting. 2 weeks ago, this was 50-50. 50-50 that they would do nothing or decrease the rate by 1/4%. In the last couple of days, that's up to 99.9% chance that they cut rates at the September 17th meeting. So obviously, that there's a month between now and then. A lot could change. The news could change. Something could happen that scares them off of a change. But this is about the most confident I've seen a rate cut since we started this high rate market, which is awesome. The October meeting, they think about a 70% chance of another cut, another 25%. Or 20, sorry, 0.25%. What about December? About a 60% chance in their opinion right now for another cut. That would be 4 cuts on the year and 3 just in the last 3 meetings of the year, getting the Fed rate down to about 3.5 to 3.75%. That's pretty huge. Now, some of this is already baked into the rates that consumers are seeing, but these kind of cuts are going to mean a lot to where the market heads. It feels like we've been really stuck at this high rate kind of market for a while. And I think that some confident cuts could really mean a lot to consumer confidence. It could mean better monthly payments. It could mean, maybe buyers a little more interested in moving and maybe a little less picky, which it kind of feels like that's what we've been running into this summer. Any questions or anything or comments or anything on the market? Nothing in chat? Okay, I'm just keeping an eye on everything. Cool. So yeah, I don't know. It's pretty nice. I mean, it feels like good news. If you're trying to make calls and you've got your list of people who said they'd love to buy, but they don't like where rates are at, I don't know. This might be a good opportunity to start looking at the market and get into something. Don't forget we have our buy now, refi later program. And if rates take this big of a drop, even if someone bought now, refinancing to drop your interest rate 1% is a no-brainer. I mean, even if you bought now and you refi next year, it would be worth it. So, got one comment. Yeah, I think now's a great time to buy a house. There was a question in chat I should clarify. I want to buy a house, so is this the right time or not. I think it's a great time. I think that you've got leverage right now if you wanted to. We're seeing, and I'm sure, everyone can agree with this, that inventory's up a little bit. Buyers seem to be a little pickier, which is still keeping the market a little bit slow, but you might have an opportunity to get something at list or under market, and then you can just refi that rate down eventually once the rates drop, which it's starting to feel like there's some confidence in the economics that rates are going to start dropping. Obviously, I'll knock on all the wood in my house right now because I don't know. I can't guarantee it. We don't have a crystal ball, but it feels like we're trending in the right direction. All right, so I'm gonna hop over to this is a peek at where rates are right now. Bit of an asterisk caveat with these numbers. I'm sure you've heard me say it, DJ say it, Sean say it, but these rates that are posted on Mortgage News Daily are from a survey of, I believe it's about 500 different lenders all across the country. They all have differing closing costs and lender fees. This is just a survey of what their kind of offered rate is. So usually what most lenders are throwing out there includes some kind of origination cost on top of their regular lending fees. So keep in mind these numbers might have some extra cost baked in, but you can kind of see that we're hovering around 6.5 on the 30 year. The 15 year is down under 6%. You can pretty confidently get 5.99 on a 15 year, which is awesome. The ARM rates have started to be a little bit better. There was a while there where I was telling people you don't even want to know what an adjustable rate mortgage is right now. The yields on them are too low because we're in a lower trending interest rate market, meaning a lender's not going to say, yeah, here's a sweet deal on a loan program where your interest rate gets better right away, within the first 3 years. They're going to want you to pay a premium for something that's going to get better over time. Well, now we're kind of in an interesting spot where I think you could weigh the options of getting like a 7/6 arm, which is means it's locked in for the first 7 years and then it adjusts every 6 months after that. Uh, you can kind of see here if the 30 years at 6.5, you're in the low sixes on a 7/6 arm. Those have 30-year terms standard. So it's pretty close to what you'd get with an FHA loan, which has government backing. So worth a conversation. I wouldn't say it's a slam dunk for everyone, probably just for people that are pretty well qualified, putting a good amount down. But worth mentioning. Um, And then the 20 year. You'll hear Sean's favorite term is the 20 year. He loves the 20 year because it's a nice right in the middle of the 30 year and 15. Not necessarily right in the middle of the term, but the pricing winds up coming out to be pretty aggressive compared to the 30 year, and the payment shock is not as bad as the 15. So you get a lower rate without having a super high payment. The catch with the terms, it's and we'll do this obviously, but just so you know, the amortization, bless you, the amortization is the key to that shorter term. So like if we look at lifetime interest when we're comparing a 15 to a 30, it'll make all the sense in the world because even though your payment's higher, you know, relatively higher, the lifetime interest is like less than half. So when you see someone, when you say, okay, well, your payment's going to be a couple $100 more, but I'm actually going to save you $100,000 over the next, you know, 15, 20, 30 years that you own this home, people are like, that's insane. That's an investment property or something for me. So that's usually the way I like to go about it. Any questions on the rates or anything? Anything in chat? No? All right, cool. I'll keep it rolling. See here. I might have to reshare because this is flyers. All right. So on to the portion of the presentation that is the calls we've been getting recently. First one being temporary buy downs. I feel like we cover this every now and again when the market seems to tighten up a little bit. Seems like sellers are trying to get aggressive but get creative without having to do price cuts. And every time that happens, we wind up getting a handful of calls about buy downs. So just as a reminder, drink water real quick. Just as a reminder, the buy downs, you have a handful of options, but the most popular one is a 2-1 buy down. That 2-1 buy down is almost exclusively funded by a seller concession. And basically, what the seller is doing is prepaying interest for the buyer for the first 2 years. They are effectively prepaying enough interest over the first 2 years to lower the interest rate by 2% in the first year, 1% in the second year, and then year 3 through however long they're going to have that loan, the interest rate goes back to the normal number that they had closed at. So in this scenario, 7% is what they're technically qualifying for at closing, but because the seller has prepaid the interest, they effectively have a 5% interest rate in the first year and a 6% interest rate in the second year. What a lot of people don't realize is that money, because it's a seller concession, it goes into an escrow account that's managed by our servicing department. So that's money that is theirs. It's just being managed by us. And we're on their monthly statements, they'll literally see their normal payment minus the amount that we covered for this buy down. And then they'll have a little escrow box that shows here's how much you have in escrow, and here's how much we used on this payment, and here's how much you have left. If they were to refinance before all of that money from the seller is used up, they get a credit, they get all of that back at closing. And in some cases, that could be enough to cover their refinance costs. So this could be a huge tool for buyers, even if they're negotiating, on a price and on a seller concession, to get a lower payment in the first year, just kind of ease into that payment. And let's say, we have a declining rate market, like it feels like we're going into, and it makes sense to refinance before all that money's used up. That's perfect. I just closed someone, they closed in October of 2023 with a 7.99% interest rate, which, right? That sounds shocking. Well, they did have a seller concession to do a 2-1 buy down. So their first year, the interest rate was 5.99 effectively, which is a lot more palatable. In 2024, that jumped up to 6.99. And at the end of this year, that rate would have gone back up to 7.99. Well, ahead of that, because we're anticipating the rate going back up and they still have some money from the seller in escrow, they decided, okay, let's go ahead and just refi now. We refinanced them into a 15-year at 5.99, and they ended up getting a check at closing for $500 because the closing costs were covered by the leftover escrow money they had. All they had to do was pay for the appraisal up front, and then they got a credit for the $500 at closing. So it's a great tool. A lot of people think it's like a loan program or something special. It's not. It's a tool that we have at our discretion. You can do it conventional. You can do it on FHA. You can do it on VA. It's a great option, and it could be something too for your sellers if they want to advertise some kind of promotion on their home without, doing a price cut or something. This could be something they offer. So, any questions there?
Hey,
Jeff?
Chris, it's Chris Case. Um,
Hey.
would this be good for a seller that maybe has all equity in their home, like it's completely paid off and they have the extra money to kind of throw out that way? Like, because I take it would come out at closing, correct?
Yep, that's exactly right. It would just come out of the proceeds from the sale. So
Okay.
it's basically like a seller concession. They don't have to fund anything up front. There's no cost to do this. It's just how we use the seller concession money instead of paying off closing costs or whatever up front. We just stuff whatever amounts needed. It's usually about 2% over into that escrow account at closing.
Okay. All right. Thanks.
Yep. All right, cool. And then my final topic here is about new construction. So, uh, builders are getting pretty aggressive from what I hear out in the market. It sounds like building might have slowed down a little bit, and they're starting to get aggressive on pricing. We've gotten a lot more calls on new construction and what options do we have for a loan with new construction. So I wanted to go over kind of the two main options with new construction and get into some of the details on that process. So the first is an end loan. You'll hear it referred to as an end loan. What that means is the builder is going to construct the home all out of their own pocket. They'll probably require some kind of deposit. And then once the construction is complete, you have occupancy certificate, all the permits are done. At that point, then the buyer will close on a loan and buy the finished product. We can absolutely do that. That's very easy. There's literally no catch to it. It's just like a normal loan process. It takes a long time, right? Because we get them all approved up front and then we sit and wait for the construction to be completed. Um, with that, or I'm sorry, alternatively to that, I should say, is our actual construction to permanent program. And what that means is the builder's not going to be putting up their own funds. They are going to basically be drawing on an existing escrow account so that they have enough funds to do each portion of the build. So let's say we have a plot of land in mind, or even the buyers own it already, and we're going to do this loan program up front. We close one time, and all the money needed to do the construction is put into an escrow account. The builder, having completed everything up front with like the permitting and the drawings and all of that, they're ready to start construction. They'd reach out to our construction department, make a request for a draw on those escrow funds for enough to cover digging the foundation. Okay, and we would release those funds. They dig the foundation, and now it's on to the next step. Then they reach out to the escrow department and they request enough to pour the foundation. Okay, and then then they pour the foundation, and then so on and so forth, the lumber and all of that. Once it's all done, at that point we'd get occupancy certificate, and the buyer would be able to move in, and the loan would start with its normal terms. Now, it's technically a one-time closing, meaning they're not closing on a construction loan and then closing on a final loan again. They just close one time, and then the construction portion is put in that escrow account. The only catch is during construction, you'll either have to make delayed payments or interest-only payments. So even though they don't live there, there's very likely some cost to have the construction going, uh, you know, while it's being done, basically. They're going to have some kind of monthly payment. We can do those on conventional, FHA, and VA. We service them in-house. We have in-house insurance to help with because there is an insurance policy that gets taken out during the construction process. Everything is managed by our construction department. We can do long-term rate locks of not 9 months to a year and even longer with some cost for a further extension. And there's Oh, yeah, the last thing is interest only options are available. One cool thing that I ran into, because I got a call about this the other day, you can do manufactured construction with this program on conventional FHA and VA. The call I got was from someone the other day. They bought a plot of land from the land bank in Cleveland, and they had spoken to a manufacturer who would be willing to manufacture and ship a home to their land. The only catch with it is they have to own the land. It has to be an individually parceled piece of land. It can't be like a lot in like a park where they're renting the land and the home kind of sits there. It's going to have to be stationary and attached to the land, and it can't have wheels. That's the other catch. Can't have a hitch. Can't they can't roll it away one day. But we can do this manufactured product with our construction loan program, and FHA will let you go all the way up to 96.5% financing. So 3.5% down. Conventional, you can do 5% down. VA, you can do 100% financing even on these. And with FHA, as long as we're getting an approval in the underwriting system, you can push it even up over 50% debt to income ratio. So this is a really awesome program that might fit into some kind of niche needs. There's a few stipulations, what we call overlays to the program. Can't be single wide trailers. It's got to be like a double wide. Obviously, it's got to be on its own parcel of land, like I mentioned earlier. But pretty cool program. It was an interesting phone call. To be honest with you, when they laid it all out to me and I was taking notes, the whole time I'm thinking, there's no way we're going to be able to do this. And once we got off the phone, I said, I'll call you back once I know more. And I started digging in, and sure enough, we absolutely can. So, if you have someone that you think kind of fits into this, or they're trying to do something that's, what is probably a non-traditional approach, I believe it or not, we can do it. Any questions out there? Comments? Any questions about anything at all, even unrelated to any topics we covered?
Chris,
Yeah.
uh, recognizing how old I am, years ago I learned when you're talking about refinance, you should be looking at a minimum of a 2 point spread from old rate to new rate and justify it by the length of time you plan on staying in the home.
Yeah.
Any of that still hold true?
Um, you don't need as big of a spread these days for it to make sense. What we usually say is it's good to start the conversation if you're reducing your interest rate by a 0.5%. When you get to 1%, as long as you're going to be there for another 2 or 3 years, it starts to be, what I jokingly call a no-brainer. Like we almost, it's going to be worth it to refinance now and then maybe refinance again rather than, wait and see where you land eventually. Um, I had someone closed in October of 23. We did a VA loan at 7.99%. Now, it was a good loan amount. It was like a $400,000 loan, but they closed at 799 VA 100% financing. Last year, around like June, if everyone remembers, rates took like a big unexpected drop and they were only low for a handful of weeks, maybe 2 or 3 weeks, and then they shot right back up. Well, during that time, VA rates got down under 6%. So I called him and I said, your rates right now is at a 799, and I could get you down to a 599 and at your loan amount with nothing out of pocket because VA does that, the interest rate reduction loans. It lowered his payment like $400 a month. So much so that his break even was like 6 months. So that scenario obviously meets your 2% spread that you were mentioning, but gives you an idea of how quickly you can break even on these refinances. So, he was going to break even on it within 6 months. I was like, "Are you guys going anywhere?" He's like, "I got kids that go to the school district. We're not going anywhere." So I was like, even if rates go even lower than this, refinance now, drop your payment, break even in 6 months, and heck, if it goes down to 499, which would be a shock, but I'll call you back. We'll do it all again. So yeah, I would say 0.5% starts the conversation. 1% starts to be like, we should really do this. Anything more than that, I think it's definitely. And 2%, I shouldn't be calling them. They should be calling us. They should be begging for a refinance if they can drop their rate 2%. So if you talk to anybody that they say, yeah, I've got a rate close to 8%, even 7.5%. It's worth a conversation, and we're happy to have that. Good question. Anybody else? Anybody running into anything weird? Nothing? All right. Well, it might be a quick class, but if you need anything at all, I appreciate you attending. Thanks for hanging with me. I probably was not as funny as Sean, but um, I appreciate the attendance, and we'll be back next month. Let's see here. Email the flyers. Sure, happy to email you the flyers. I'll have to double check and see that I've got your email. I think I do, but 1 second here. If you'd like the flyers emailed to you, anybody in chat, let me know, and I'll send them over to you. All right, cool. Well, thanks everybody. I appreciate it.
Thank you, Chris.
Thank you. Have a great day.